So welcome to our event. You're going to give a presentation about sustainability in listed infrastructure. So so go ahead and maybe I might interrupt you if I have a question or somebody from the audience or online. But just go ahead.
No, please do interrupt me. Otherwise, the room could be very empty in a few minutes. I think maybe just to give an introduction on who I am and who we are. I work for KBIGI Global Investors, and we're majority owned by the Amundi Group. But I think in terms of our business, we are very much a specialist investment firm. I don't know whether you have slides in front of you. I had thought you did, but it's not essential. I think when we sort of look through the first slide of that. There you are.
We have slides. We have the slides here in front of us and on the screen, so no problem.
Yeah, no, thank you for that. So just quickly in terms of KBIGI Global Investors, I think we really see ourselves built upon a number of founding pillars. The first we would say is being differentiated, not having a sort of follow the herd mentality. We like to be first to market with sort of unique, differentiated, value-adding investment strategies. And I think that's probably exemplified by us launching a global water and a global energy transition strategy almost 20 years ago. So really trying to offer unique products, possibly a little too early on the energy one, but today it's obviously resonating with a lot of institutional investors. The second pillar, I would say, is the stability and experience we've built up as a firm. Those 20 years, we've had very little turnover of our investment professionals, our senior management. I myself have been there about 23 years now. So that it just sort of highlights the tenure, stability. And I think that's really important for our clients. You'll see on the slide there that we've very much a global client base, diversified across all global major regions, and also diversified across all types of investors, be it public and corporate pension plans, defined benefit, defined contribution, foundations, endowments, private banks, family offices, high net worth, sub-advisory, etc. So we've a very diversified client base and a strong stability in terms of that client base. A point that's often lost is the operational excellence that you required, operational compliance in order to operate in all those jurisdictions. Adhering to the best-in-class standards is critical for businesses operating in the US and Canada and the UK, Ireland, and across Europe and Asia as well. And the next point I would highlight, which is probably important given the theme of the subject, is responsible investing. And I think coming from Ireland, being part of Europe versus other regions across the world, it does put you at the forefront of ESG or responsible investing, however you want to think about it. But it's important to have a holistic approach for our business. That means having dedicated resources. It means having policies and procedures in place, a committee, responsible investment committee, and basically applying responsible investing practices across our entire suite of strategies from start to finish, be it the integration of ESG criteria into our stock models, or be it acting as stewards on behalf of our clients' capital. And I think, as you'll probably allude to or know, is that as a small boutique, collaboration is very important for us. And actually, being part of the Amundi Group is important in that respect as well. So you'll see some of the entities that we are aligned to in order to get a louder voice, I guess, in global markets. So maybe if I can ask you to move to the next slide, please. And we'll maybe just talk a little bit about sustainability. I think that the subject title probably says it all. I think every major or significant investor across the world today, be they institutional or high net worth, are looking to increase exposure or add to their exposure to sustainable investing. I think if we think about sustainable investing, we believe that it's best achieved through the infrastructure asset class. Why is that? well, infrastructure effectively is the backbone of the economy. I think if we're to meet the United Nations Sustainable Development Goals and the objectives set out in 2015, I think infrastructure has a critical role to play. And maybe just to give you a quick example of that is, you know, a low carbon strategy might have an allocation to a Facebook, for example, or a social media company or an internet giant. Or an infrastructure company might have exposure to a European utility which is spending significant amounts of money on building out renewable assets, upgrading the electricity grid to allow intermittent sources of energy be plugged into it, to reduce inefficiencies with it, plowing money into alternative transportation fuels, into technologies such as carbon storage, capture and storage, or battery storage. So for us is, well, which one of them is going to be critical in terms of us meeting the objectives of net zero emissions by 2050? And a very obvious answer for us, it's really about the infrastructure. It's about the utilities. They're the energy intensive businesses that need to transition in order for us to get there. It's not about investing in a tech company or a food and beverage company like Pepsi or Coke. You got to have an infrastructure allocation in your portfolio. So as a starting point, we believe sustainable investing can be best achieved through investing in infrastructure. And I think when you see this slide here, you'll think, and maybe some of your audience will resonate with it, is that when you look at infrastructure, what are the key criteria you're looking for from an asset class versus other asset classes? And it's really about investing in asset intensive, often monopolistic businesses that have very high barriers to entry, that have very long-term contracts with highly regulated governments or municipalities to provide a critical service to the local or global population. It falls into the real asset realm, which means that you can get inflation protection through it, be it through those rates that you have contracted, or be it by the fact that you can pass on costs to your clients because you operate in a monopolistic market. When we think of listed infrastructure, we actually think that it brings additional benefits, which you'll see on the right-hand side there. You can get diversification across multiple geographies, across multiple projects. You get immediacy in terms of your investment. You get lower costs, less complexity for investors. And from that perspective, we don't believe that it's either one or the other. We think they're both complementary, and natural gravitation for investors is to gravitate towards private markets, because private markets are priced differently and more infrequently than mark-to-market in public markets. But I think the point for us is that there are a lot of benefits that a listed infrastructure allocation can bring. So we start with sustainability, infrastructure, and then listed and private is I think the way I'm sort of thinking about this subject.
And why did you put listed between brackets? Is there a reason for that?
Listed between brackets. I'm just trying to see it. Oh, it's listed. Sorry. It's. I guess people might know what listed effectively means, but listed means it's listed on a public market.
Yeah.
So there's no subtleties about what we're trying to say in that slide. It's basically infrastructure as an asset class, and then listed and private, and which ones would investors typically look to. And I think listed is certainly a rising asset class. We're seeing increased interest in it because of the liquidity it brings. There's no long-term call on capital. You can get in and out of it straight away. And I think what we'll sort of come on to on the next slide, if you don't mind, is
some examples.
Yeah, sorry. So when we think of infrastructure, what are the trends we're seeing, and what are the biggest infrastructure investors across the world doing in the infrastructure space? And if you think about the biggest investors in infrastructure, it's Allianz, which you'll see on that slide. It's Canada Pension Plan. It's a lot of the Canadian plans, actually. It's some of the UK plans as well. So you'll see London Pension Fund Authority there as well. Macquarie, one of the biggest investors in infrastructure across the world. So what we show here is where there are infrastructure projects across the world that are co-owned in the private space and in the listed or public space. So the first point I would make on this is, well, where are the biggest infrastructure investors allocating their money today, and why are they doing that? So, you think of a waste energy facility that you see there. You see a big water infrastructure project, sanitation project, and you see a large offshore wind project. And actually, there's plenty more examples of it. If you think about Pattern Energy, which was acquired by Canada Pension Plan in 2019, it was bought because it was owner and operator of high quality wind assets across North America. When it was purchased by Canada Pension Plan, it was acquired at a premium to its previous close of about 15%. The project you'll see at the top of that slide is actually a Dublin waste to energy facility owned by Macquarie. It's a state-of-the-art one recently built. State-of-the-art I mentioned because it minimises emissions. The alternative to waste is that it gets put in landfill, which has huge emissions emanating from it. So waste energy is an attractive business model because it eliminates waste from society, and it does so in a very smooth way, and it produces energy in the process. And you'll see Covanta there. Covanta has actually just been announced as being acquired by another big infrastructure player, and that is at a 37% premium to its share price. So what this slide shows you is that there is availability of high quality infrastructure assets in public markets. It's the key message. It also shows you, well, what are the biggest investors in infrastructure doing at the moment? They're investing in water, they're investing in energy, and they're investing in waste energy in terms of sanitation as well. So I think that the next example we probably could allude to is the Dogger Wind Bank, offshore wind bank, which is co-owned by SSE and Equinor, which you both have heard of. This is going to, by 2026, produce enough electricity to power 6 million houses in the UK with electricity. So these are the sort of projects that are happening today. And if you are thinking about, well, what are the big investors doing? What's the availability of assets in the public market space? I think this is a useful slide to think about.
Mm-hmm. Gives a good picture indeed.
Yeah. And so maybe then just to move on to the next slide, because I think this is one of the challenges that we see in listed infrastructure, is that equities are market cap driven. So what is your market capitalization today? It's there because of what has happened in the past. It's not forward-looking. Market cap investing can be dangerous within the infrastructure space. And to give you an example of that is a lot of infrastructure investors will have significant exposure to oil and gas pipelines, storage, and they will have a lot of exposure to transportation infrastructure, which tends to be, of all the infrastructure categories, the more cyclical or economically sensitive. For example, I guess more people go on holidays and use airports and flights when things are good, and maybe less so when things are bad. But there are risks in that, and you could talk about stranded assets. You could talk about Biden recently revoking the Keystone Pipeline permit, and there's a big overhang in terms of having a more backward-looking infrastructure mindset in the listed space. Similarly with transportation, you don't see a significant amount of new airports being built today, or new toll roads being built today in emerging or in developed economies. So our objective when we think about it is to get the same characteristics that we alluded to on the previous slide, which is asset-intensive businesses, long-term predictability, strong contracts with governments or municipalities, but is to have a forward-looking mindset and take the example of what we saw on the previous slide. Where is money being spent today? Where is money going to be spent in the future in infrastructure? And again, that's key for us. And if we do that, can we buy companies at more attractively valued prices and valuations? And that's really, I guess, the benefit of being, as I alluded to at the start, is trying to be differentiated, trying to have a value-added proposition, and trying to have a forward-looking lens in the infrastructure space. I think then maybe if we move to the next slide, which brings us maybe to what we believe are indisputable megatrends that have been happening for the last number of decades, but are getting even more pronounced today. And you'll all be familiar with these. I don't need to really go into much detail on them, but the world's population is getting bigger. Cities are getting bigger. We're seeing increased industrialization in emerging economies. We're seeing increased affluencies. And that is all putting a significant supply and demand constraint on our resources, on the world's resources. But our most critical resources are food, water, and energy. And if you think about food, water, there is no substitute. And yet we're seeing exponential increases in demand for them as populations grow, as cities grow. And that is putting a strain on the globe. And as a result is leading to increased regulation. Within energy, fossil fuels, which is what the vast majority of the energy mix today, are finite and polluting. So from our perspective, the shift towards net zero means that they are going to be, I guess, a headwind in terms of regulation, whilst clean energy will be a tailwind of regulation. And the reality is governments, policymakers across the world have to act now in order to put in place regulation, to put in place policy in order to tackle our most critical challenges driven by what these 5 indisputable factors are. And in order for them to do that, they need to see increased spend on infrastructure. And that suits them because we're in a low interest rate environment today. Monetary policy stimulus hasn't necessarily worked. Fiscal stimulus hasn't necessarily worked, although that's an area that could increase. But infrastructure has a significant multiplier effect. And if they're trying to build infrastructure for the next number of decades, for the next generation, it will create jobs, it will create economic momentum. Plus, they have to do so within some of the big regulatory contracts that they're making in terms of achieving net zero from Paris. What are they going to do in Glasgow in the next month? We think we're at a pivotal situation in that. So these are indisputable drivers, long-term, multi-year, multi-decade, driving the supply-demand imbalances, making it essential for global authorities, global governments to act in terms of the regulation. And regulation is critical for infrastructure investors. Having poor regulatory oversight of your asset means in China, for example, you could have your asset privatized, or you could come under severe pressure because that contract to supply the electricity grid with energy for the next 20 years is gone. Mm-hmm. That's why regulation is so important. It's why most infrastructure investors will have the majority of their assets in OECD, developed nation economies. Okay, so that's kind of the genesis of how we think of the world today, and I think let's start with the regulation. The regulation, I've alluded to at the start. It's essential. The COP21 from Paris definitely represented a pivotal moment for clean energy, for the energy transition. But today we've seen a huge amount of countries representing. I think by the end of this year, we'll have 3/4 of the GDP of the world committed to net zero by 2050. No one knows how to get to net zero. So the International Energy Agency is a great example of, putting in place a roadmap. Well, how do we get to net zero over the next 3 decades or 29 years? It's not that far away. People think it is, but it's gonna move fast, and actually we think a lot of the pressures are going to come downstream very quickly as those global authorities sit in Glasgow in a few weeks' time and think we haven't done enough. We are at a pivotal moment. Global warming has accelerated too far ahead of us. We need to put in place a significant action plan now. But the IEA, which is the International Energy Agency, set out this roadmap, and it basically is saying to us that today, the global electricity system is producing 23 terawatts an hour of electricity, which is mostly dirty fossil fuel energy. In 2050, the global electricity system will have to deliver 3 times that, about 60 terawatts an hour of electricity, of mostly clean, carbon-free electricity. So that is a huge change. So we're at 20 today. If you think about the energy system today, to 60 in 30 years' time, based on the needs of the global economy, and the shift that has to happen from clean energy, from fossil fuel energy to clean energy. That marks a huge transition for us at KBI Global Investors. We think it's startling. And if you think about wind and solar today accounting for less than 10% of the energy mix, having to go to 66% is what the IEA suggests. I think more importantly, actually, is what the IEA suggests is that there is no future for coal, unabated coal. There's no future for oil. There's no future for unabated natural gas. So where is that energy going to come from? And, you know, going back to that thesis at the start, is that's why infrastructure is so critical, because we need to invest in the companies that have to invest in the future. There's no point in investing in social media companies or internet companies. In order to get there, we want to be investing in the renewable energy generators. We want to be investing in the electrical grid operators, the owners and operators that are upgrading the very outdated infrastructure that's already there. That was essential anyway.
Peter, we have a question from the audience.
Sure.
Yeah, thank you for your clarifying story. I agree with you that the three sources are crucial for the future, like water, food, and energy. But all those investments require still a lot of steel and also cement. Is this also on your horizon? How to transfer to other usage of material? Because all those windmills, they are still based on steel.
That's a great question, because the honest answer is, within this strategy, no. I think when we go back to the start, we want to be investing in the owners and operators of the infrastructure because of what the asset class demands of us. Within other strategies that we manage, the answer would be yes, where we have a kind of a more investing in the technological companies that are heavily involved in that, or material companies that are extracting material that is essential for what you spoke about in order to get to a clean energy economy. But
is it counted as a factor, for example, as a discounting factor, as a minus in the investments, that the percentage that old age steel is used, or the steel produced in an old way, or the cement used in an old way? Because there are also already new technologies able to have a much less carbon exposure.
There are, and I think that those companies are very much at the front of the technological advancements in it. As I said, they would be a consideration in our other strategies, but within our infrastructure, that will feed into our kind of inputs into our what companies we own. The critical thing about infrastructure is the concept of, you know, how do they get into our universe? It's the owners and operators of the infrastructure assets. It's the monopolistic businesses. The businesses that you're referring to aren't the owners and operators of it. Yes, they're an input into how the solution effectively happens, and that solution is just as critical, don't get me wrong. But the specific asset class that we're looking at, it has to be all about very high barriers to entry, monopolistic businesses, long duration contracts. If you think about why those investors like Canada Pension Plan invested in infrastructures, because of the long duration entity of it. But you're absolutely right. I think cement, steel are two areas certainly that the world needs to focus on as well, because they are heavy emitting. Similarly to transportation fuels, we need to invest in green hydrogen, which will be an area that our companies are investing in. Green hydrogen today isn't a viable source of fuel for us, but we believe it will be, and that's where our companies can make a difference in that realm.
Yeah. Okay. Thank you. So you have some 5 more minutes. So just go ahead.
Sure. I guess I'm going to finish maybe in the next 2 slides, and maybe this kind of helps to answer my question on the previous question. Was so at KBI, where do we see? Sorry, it's the next slide. The opportunities in infrastructure, and I guess our starting point isn't an index. It's not backward looking, as I mentioned. We screen in. We look for companies that meet revenue thresholds, that meet market leader thresholds, They meet our categorization of being an owner or an operator of infrastructure assets, or an infrastructure capital expenditure company that is going to be one of the first beneficiaries of a capital of an infrastructure project. So an engineering consultancy firm who's at the forefront of an infrastructure project, be it the design, the procurement, the construction of a wastewater treatment facility, for example. But when we screen our universe in, there was about 180 global stocks. We're able to segment them into the various different business lines. Those business lines are infrastructure categorized. So you'll see there in terms of companies decarbonising the energy mix, electrifying the grid, building out EV charging infrastructure, constructing water treatment facilities, water reuse, desalination, waste energy I've alluded to, farmland, the owners and operators of farmland, waste and recycling. So you can see that there's a very basic necessity around all these resources in terms of the functioning of mankind effectively and sustaining a future for future generations. And very quickly, conscious of your time, maybe to move to the final slide is going back to the start. And, you know, with big investors, with most investors across the world looking to allocate to sustainable investments, where we believe our infrastructure projects or infrastructure, not necessarily ours, can meet the definition of sustainability. Can we measure it? This isn't an input, this is a reporting tool. And every year we do this, we've done it for the last 4 years. We look through every company in our portfolio, we look at every different business line and revenue line, and we see does that business line positively or negatively influence or affect one of the United Nations Sustainable Development Goals. And we produce this mapping, which are called our RAS mapping. And where it doesn't, where it has no impact, or where it's undecided as to whether it's a positive or negative, we become neutral. And it goes back, you'll see the positive, there's a significant positive tilt in it. We provide this transparency to all our clients, providing a full report across all holdings. The negative one is actually the interesting one because, you know, some of the utilities will own legacy coal facilities, for example. In Chile is a great example of one of our companies. It is spending all its forward-looking money on renewables, electrical grid, green hydrogen, etc. But it has a legacy coal facility in Chile and in Russia, and they can't just close the facility because then that local population that is requiring that energy has a significant issue, like Texas did earlier this year. So they need to decommission it. They need to convert it. They need to convert it to biomass. So it takes them a couple of years to do it. But we use those negatives as a tool for engagement, both directly and collaboratively, in order to ensure that we're comfortable where that company is going. Are they decommissioning coal facilities? Yes, they decommissioned 2 last year. They're on the right path. That makes us comfortable with where they are moving. Because energy transition isn't about investing in a company that's 100% green today. It's all about investing in the companies at the forefront of the transition. And we actually haven't talked too much about water. You know, there are huge examples of policy around the world that have, you know, we will see more money spent on water infrastructure over the next decade than we have seen in the previous, 5-6 decades comfortably. That's in India, it's in China, it's in the US, in the UK, it's across multiple regions globally. So that's where we want to invest in. It's a forward-looking lens, it's a sustainable-looking lens. And we also believe that means that with infrastructure investors that typically look for the income and the consistency of income, we can deliver that, but with better earnings as well.
Okay.
So appreciate your time.
Yeah.
Thank you.
Yes, thank you very much for your interesting presentation.
No problem.
And have a good afternoon. Yeah.
Same to you all. Enjoy the rest of the conference.
Yeah, thank you.